Number 1, trying to beat the market. Here's Buffett's performance over the last 15 years versus the S&P 500 index. As you can see, if even the greatest investors of all time is no longer able to beat the index, why do you think you can? That's happening because the game of investing is increasingly more competitive over the recent years, and therefore the average investor is much better off just sticking to index funds rather than actually stock picking. So the question then really, why doesn't everyone just buy index funds and then holds it? I believe there are two main reasons. So the first one is the lack of knowledge on index funds, and the second one is that they have the ambition to outperform the index, even though the odds are massively against them. Number 2, paying too much admin fees. So admin fees will eat your return. If a fund is returning 10% but it has 2% admin fee, your net return will be 8%. And that number compounds over time to a much bigger number. So not many people realize this, but every time you buy or sell an asset, your broker will get the commissions for executing that trade. And that's why you want to trade as least as possible rather than being a day trader. And guess what? The shorter you hold an asset, the more taxes you pay on it too. So that's why the solution is most of the time to invest for a long-term growth. Okay, so here's an example of the admin fees impact on your investments. So with the initial capital of £10,000 as an example, option A, using Fidelity or Vanguard low-cost index funds where you pay the admin fee of 0.35% in addition to 0.07% for the index funds itself, it results in 0.42%. With £10,000, you would be paying Fidelity or Vanguard £42 versus the investment apps where the investment fee is around 1% and that results in about £100 on total fee. So you got the three main columns: the initial money, the interest that you're earning, and the fees that you're paying in each one of the scenarios. So you can see that in year one, the difference is actually only £58, so not much. But that money compounds because it is returning, on average, it's returning about 6.5% a year, average return of an index fund. So you can see actually in the formula here. So what does that mean? So in year 2, the difference you can see, you'll be paying £48 to Fidelity instead of 42 because the capital is larger now, versus 112 for those investment apps because again the money is larger now. But you can see that if you go across the years, the initial cap money, which is the total capital of your portfolio, increases a lot faster in Fidelity versus investment apps. And you can see that the major difference here is in year 30, where the difference, which is in this little table here that I compile, in year 2, the difference was £123 in the total return by using Fidelity versus those investment apps. In year 5, £370. In year 10, that would be 1,004. And in year 30, that would be 10,216. So basically, by using index funds of low cost, after 30 years, you've saved £10,000, 216, which is something that not many people realize, because when you look at the percentages, 0.35% versus 1%, it doesn't sound that much. But the thing with investment, the most important thing is that you're operating with compound interest rather than simple interest. So your money compounds on itself, but your costs also compound on themselves as well. Okay, so now you may be asking, why do those investment apps charge so much? And I think you're just paying for the comfort because they sort out everything for you in a really simple manner. It's user friendly and really easy to sign it up for them. Number 3, not diversifying enough. In a nutshell, in order to reduce risk without compromising your returns, you should invest in 15 to 20 uncorrelated bets. That means different assets such as stocks, bonds, commodities across different continents such as Europe, Asia, America, in different sectors, food, tech, advertisement, and from different companies. So in the following chart, you can see now the Holy Grail by Ray Dalio On the y-axis, you can see the annual portfolio standard deviation, and the x-axis, the number of assets. So the more assets you've got in your portfolio, the less risk you're going to get, because the lower the standard deviation will be. And as you can see as well, moving from 60% correlation to 0% correlation, the more uncorrelated are your assets, the less standard deviation they will create, and therefore the lower the risk. So what you're aiming for is 15 to 20 uncorrelated assets. Number 4, buying high, selling low. Regression to the mean, a concept explained in Thinking Fast and Slow, in which asset classes will gravitate their average growth over a course of time. Okay, so here's an example of regression to the mean. China index fund. So in between December 2005 to October 2007, the China index fund grew 431%. But following the financial crisis of 2008, it then declined 65%, returning to just a growth level of 170%, which was more fair to the China actual underlying value. And then again, you may say that it's because of the financial crisis, but again, June 2014 to June 2015, just 1 year, it grew 154%, to then just decline 44%, to then an average underlying return of 44%. So those are clear examples of regression to the mean, where psychology of the investors pushed the index fund too far, and then it returned to the underlying value later on. Number 5, trying to time the market. Nobody has a crystal ball. Nobody knows what happens next for sure. Number 6, not automating investment contributions. So automating investing means paying yourself first and achieving a dollar cost average. When you dollar cost average, you invest equal dollar amounts in the market at regular investments of time. The idea is to get the best deal on a desired investment by controlling for market fluctuations. Rather than trying to time the market, you buy in at a range of different price points. So for example, let's say you automate your monthly contribution to $1,000. Every month, 1,000 will go into the account and buy more number of shares if the market is down, as these shares are cheaper, or buy less number of shares if the market is up, as these shares are now more expensive. Number 7, operating on a first level thinking rather than second level thinking. What are the other players in the market doing? When something hits the news, it's already too late for you to invest. So first level thinking is, I think this stock will go up because the company's plan is strong, management is good, marketing will work well, balance sheet is strong. That's where most people operate in. The second level thinking is even more important, is when you start asking, what other people are thinking and how can I differ from the herd and be right? So if something is on the news, everybody knows about it. On the second level thinking that you should be operating is what piece of information is important, desirable, and people don't know about. Number 8, operating out of your knowledge zone. So here it's a quote from Peter Lynch that I think is really important, is know what you know and know why you know it. So if you work for an industry, so let's say I work for FMCG, so I'd have a lot of very important information that is shared in front of me every single day. So therefore I will focus my investments on FMCG because that's what I know the most. Number 9, thinking that they have a crystal ball. So it is futile to predict the economy and interest rates. Nobody really knows, but you have plenty of time to identify and recognize exceptional companies. So you should be looking at companies rather than macro. Number 10, not learning from common investment mistakes. So you need to be flexible and humble and learn from the mistakes. Before you make a purchase, you should be able to explain why you're buying that asset and take notes of it and go back in a year's time to review whether it has grown or declined and why. Number 11, not studying the fundamentals. So it's essential that you check the ratios of a company versus its peers, such as PE ratio or return on assets ratio. It's essential that you check when the debts are due. How does the cash flow look like? Number 12, the availability heuristic, also known as availability bias, is a mental shortcut that relies on immediate examples that come to a person's mind when evaluating a specific topic, concept, method, or decision. A lot of people fall into this trap. Is very common. Is the trap of, oh, it's the Airbnb of that industry. It's hardly is the reality. Another example of availability heuristic is you're watching the news and you are looking at shark attacks, and then when you go to the beach, you keep picturing that you're gonna be attacked by a shark, but actually the probability of that happening is very, very low. Last and not least, the bonus is the law of holes. If you find yourself into one, quit digging. That means admit when you've made a mistake before it's too late, stay in your circle of influence, and be humble. If you enjoyed this video, please do me a favor, just hit like below and subscribe to this channel.